It's time for the Your Personal Bank Show with Ferenc Toth, president and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. And folks, I'll tell you what, we got an exciting show today. You're going to learn some new stuff that most of you are probably not aware of. And I've been sharing this with some of our clients recently, and this is a game changer. So the bottom line, one of the things is, I get asked this a lot, this is the Your Personal Bank Show, and what is your personal bank? And really, from a broad perspective, it's really a financial concept where we're strategically integrating financial tools from both the banking and the insurance industry, and to get growth on funds and continue to have growth on those funds, even when you use them for other purposes. So it's a really unique and very powerful way to work with and manage your money and grow your money and have access to your money. And again, we're bringing the benefits of both of those industries. And I also have a special guest with us today, which is really quite exciting. Brandon Miller. He's the director of Life Equity Lending with M&M Bank. Brandon, welcome to the show.
Hey, thanks, Ferenc. Thanks for having me on today.
Absolutely. Well, Brandon, we've got a lot of great stuff to share today with our listeners, so we're going to kind of jump into this. The main thing is our clients really, I've been talking about this for, years, frankly, about growing cash value policies, growing cash in insurance contracts, using them primarily as a cash growth tool versus a death benefit tool, right? And they can access those funds from these policies and such. And the interest rates, a lot of the times are what we call a wash. In other words, you're earning as much interest. You're getting charged as much interest as you're earning when you access the funds. Some policies out there, as you know, Brandon, in essence, are upside down. In other words, they're getting charged more interest than they're actually earning. But you have a solution that can solve that problem, right?
We do.
Yes. And what do you call it, and how does it work?
Yeah, so we at M&M Bank have a product that we call our Life Equity Loan. I think the legwork of my 16 years in the financial sector, some of that with one of the mutual carriers and in the insurance space, has really positioned us well to work and understand the work that you as an advisor, those like you as advisors do, to work with our clients to make sure that they're putting the right product in the right place at the right time, and so leveraging the cash values within whole life insurance, within the traditional whole life, but also the variable and the universal life chassis, leveraging that as a tool for your clients to be able to access the cash that they're putting into the policy. Obviously, we know that they're designed on large part for the long term or the death benefit at the end of life, but there's always that piece of it of cash that's available. Right. How do we leverage it? Does it really make sense to leverage it at the rates that the carriers are charging? What does that do to the dividend or the growth of the cash value? And so we've worked with some 17 years, over $450 million in clients' funds of cash value that we have been able to leverage out for them to be able to use in a line of credit.
Right. And Brandon, that's why I brought you on the show, because I was so excited, because our clients, and again, listeners, if anybody's listening to our show knows that when we're structuring one of these personal bank policies, we call them, our goal, in most cases, some people have death benefit protection needs, of course, and if they do have those needs, we address it. But majority of our folks really are focused on growing cash. So we're really heavily focused on growing the cash in the policy, which means there's a lot of cash there. And then when they want access to those funds, like I said, with one of our main products we deal with, the interest rate is 5% when you take that policy loan. They're earning 5%, they're getting charged 5%. And I would say, look, if you're earning 5%, you can charge 5%, those dollars aren't really costing you. But here's the thing, you have a better rate, don't you?
We do. So, we structure these deals knowing that they're cash secured. They're cash secured by carriers that are very highly rated with all of the rating companies. And so, I typically say if there's an issue on the end of the insurance company in terms of our worry of their cash, M&M Bank is likely long gone from the picture, because in comparison to the size of the carriers that we work with, we are a much smaller institution in terms of total dollars. And so, right. Leveraging that cash that we know is secure at a low rate comparative to traditional borrowing or other types of lines of credit makes absolute sense.
Right, and if you don't mind my saying it, what I'm excited about is your rates you lend at normally are prime, but of course you have a floor of 3.95%. Correct?
Correct.
Yeah.
Correct. So all of our lines are on a prime-based rate. They float with prime.
Mm-hmm.
Right now, that's a very low rate, but we do have a floor in there because of we are as most business a for-profit entity and got to maintain that share. But we try to keep that low on the floor. So rates as low as 3.95. Right,
and the thing is, the Federal Reserve, in fact, just recently announced they were going to keep the rates at where they are until the end of 2022 now. So I'd say it's a pretty fair bet your rates are going to be pretty strong for a while, aren't they?
Yeah, I think that's an absolute fair bet. And I would even say to that, there's a likelihood with the long-term projection of low rates that, we'll reassess portfolio and see what it means. But, that long-term low rate means that our borrowing cost goes down, which means our floor could likely slide with that a little bit as well. So even better news for potential and future customers.
That's interesting. And so if somebody had a whole life policy, like you mentioned, or an IUL, or let's do the whole life one first, okay? How much could they access from, they have some cash in there. How much they could access from it as a line? Because understand the line of credit, your line of credit is, the policy is the collateral for the loan, right? The cash value in the policy, correct? Right. So how much of that cash could they access through a line of credit through M&M Bank?
Yeah, so we run up to 95% loan to value on the current cash values.
All right.
Of course, the traditional whole life at 95%.
Right.
And then down to 75% on some of the other variable or UL type policies, simply because of the fluctuation in values.
Right. And I know you and I, Brandon, this is big news. I just want to announce this for, like I said, a lot of our clients and folks out there will be excited. We've just got an agreement with you to offer that on Index Universal Life at the 75% also, correct?
Correct. Yeah, we took it to our team and, feel like that as we learn in this space as well, coming out of a company, again, 17 years in the space, most of that with one carrier, that most of those products are traditional whole life.
Right.
Our commitment over the last 18 months has been to grow. Right. And not just with that carrier, but to grow across the carrier lines. And so relationships like this that you and I have entered into and our work together and conversations thus far, we took it to our team, let our leadership look at it, and feel comfortable and confident that the IUL, just as any of the other products that have some variable rate or fluctuating rate options are worthwhile to go ahead and jump into.
Yeah, and as you are aware of, that's one of the fastest growing areas in the life insurance industry is the Index Universal Life, because it's got, upside potential, market type potential with a downside floor. So I had asked you, and we discussed this too, like before I brought this to the radio, like what's your capacity, Brandon? I mean, if we're going to send too many people your way, or can you handle it?
No, I mean, our capacity, this focus and book of business is a primary book for M&M Bank. Okay. It is our largest lending portfolio. We're a local bank to the Chicago markets, the Oak Brook Terrace, Naperville area, and small brick and mortar presence. Mm-hmm. Have a fairly sizable commercial real estate portfolio, but our commitment and our focus has been in the life equity business, again, for 17 years, and over the last 2 years consecutively that we've had year-over-year best performance or best growth in those years.
And, of course, this is available nationwide, correct?
Correct, yes. Yep. Everything. So we've worked with carriers or advisors in every state, have had a couple crossover into Canada. They get a little bit more complex, but right. We have been able to reach across that border on a couple that made sense.
Well, I'll tell you what, Brandon, we're going to keep you on through the next couple segments, folks. This is exciting stuff. And if you haven't grasped really what this means, is the bottom line with these insurance policies that are growing cash, a lot of the time, typically, whatever interest rate you're earning or wherever you're growing can typically be more than what the bank line of credit would cost you or what the bank would charge you. Therefore, you create a positive arbitrage. Or in other words, if you have monies that you're using with the line for other purposes, whatever that may be, you're still going to earn a positive return on those dollars, even though you spent them elsewhere. Stay tuned in the next segment. Brandon and I are going to go in further detail on this.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to the Your Personal Bank Show. And we've got a special guest with us today, Brandon Miller. He's the Director of Life Equity Lending with M&M Bank. And M&M Bank has a quite unique or interesting line of credit where we use life insurance contracts, life insurance policies with cash values, and the bank will offer a line of credit. Against that, the cash value of the policy is the collateral. And in most cases, we find when we work with clients that the interest, the growth in the policy is greater than the cost of the line of credit. And therefore, that creates a positive arbitrage situation for the client. In other words, they're earning more than they're getting charged, and they're using their money for other purposes, whether it's paying off debt, buying things, or investing in other things, but their money is still earning and growing. And Brandon, I just want to welcome you back to the show.
Hey, glad to be here.
Yeah, absolutely.
Look forward to continuing the conversation.
Absolutely. Well, if you missed the first segment, I'm going to recommend tell you to go to yourpersonalbank.com and definitely listen to the first segment. We talked about introducing this idea. But during the break, Brandon brought up a good point. I pointed out, just like I just did now, in most cases, you're earning more in your policy than the line of credit is charging you, creating a positive arbitrage. Your money's earning, growing for you going forward. But, Brandon, you brought up a good point about the interest on the line of credit loan. You want to elaborate on that?
Yes, I think just talking about arbitrage, one of the things that we find quite often is these lines of credit are used and leveraged by either existing businesses for operations expansion, whatever it may be, payroll or any of those, but also for business startup. Maybe it's to jump into the real estate space and begin real estate investing, whatever it may be. And one of the conversations that oftentimes come up, working with the advisors that I work with and their clients directly, and knowing that they've been able to leverage the arbitrage even further through some tax deductibility or potential tax deductibility, to be clear. Mm-hmm. We can't speak as it relates to the business, how your CPA will or tax consultant advisor would look at the funds and how that interest is used. But the interest paid, there's a likely possibility that there's a tax advantage or tax deductibility, which just further separates that arbitrage from what interest is paid to what is earned in the policy, making it that much better for the client to leverage funds such as this. One thing that's interesting is that's leveraging it through a line of credit, not through the policy itself.
Right. And remember, folks, if you're listening, to make this clear, we're talking about a bank product and an insurance product working strategically. It's a strategic synergy, if you will. The two products working together. Your insurance policy, your contract is growing cash. And by the way, in most cases we deal with, we're dealing with accounts that are growing tax deferred. And so using the MEC rules, the Modified Endowment Contracts rules that are out there. So most folks are able to grow their money on a tax deferred basis. And you're not taking money from the policy. So the funds are all in the policy basically at all times, growing and earning and doing its thing, right? We set up the line of credit like Brandon's talking about separately. The collateral for that line is the cash value in the policy. And now you deal with the bank, the line of credit, when you want to access funds. And as I think, as you so eloquently put it, Brandon, oftentimes when those funds are used for business purposes, the interest on that can be a tax deductible situation. So it's
absolutely,
yeah. As I often find with many of my clients, it's fun. They're growing money tax deferred. They're not paying taxes on the money growing in the policy, and then they're accessing and using some of those dollars. And guess what? They get a tax deduction as a result because it's a business purpose. So pretty cool combination.
Yeah.
Now, like I said, we
absolutely.
Yeah, and the rates, like I said, you had mentioned, Brandon. Right now, you're at the floor 395, correct? On these lines of credits.
Correct.
And which is much
correct. Yeah, all of our clients are sitting on that floor 395, as you alluded to. I mean, we don't anticipate that moving for a while, at least till till the end of 2022 with the latest news. I mean, it's going to be a long-term low-rate environment for sure.
Exactly. So anyone out there, by the way, I was just going to say, if you're listening and you have a policy right now and you've borrowed some funds from it, or you're considering borrowing some funds from it for whatever reason, and you find your interest rate is probably going to be 5, 6, 7, maybe even 8%, right, Brandon, out there?
Yeah, I think what we see with carriers is typically between 5 and 8.
Right.
A few that may be a little lower, but I think it's fair to say 5 to 8.
Right, pretty. And so if you're already paying, or you're contemplating that, I should say, you really should contact us at Your Personal Bank. We can connect you with Brandon and his team and show you where, like I said, you can access those funds at a lower rate. And again, if it's for business purposes, potentially have a tax deduction on top of it. One of my statements, I meet with so many clients, and again, this isn't for everyone, but I often hear this statement from when I share this with folks who it clearly is a good fit. The response I get most often, Brandon, is, well, gosh, this is a no-brainer. So that's what I hear a lot. So you already mentioned this too,
Absolutely.
Brandon. Yeah. Brandon, here's another thing you mentioned about the interest. I get this asked all the time. Well, we understand rates are low and all this, and of course the Fed just announced that they're going to keep the low interest rate environment through the end of 2022. So obviously for the foreseeable future, we're going to be in a lower interest rate environment. But down the road, what would happen if interest rates did eventually go up at some point? What could somebody anticipate?
Yeah, great question. So, all of our lines, the sheet rate within the terms of the line itself are based on a prime to prime minus factor.
Okay.
Once rates do start increasing, as they will, things will recover and the economy will shift again, and rates will go up at some point in the future. When they start going up, a couple of things happen. The rate's going to start trickling up with prime. So right now, if prime gets to 4 and it bumps 0.5, or it gets to, depending on the prime minus factor, it gets higher than the current floor rate. A couple of things that can happen, and a couple of conversations that we have with advisors and clients alike is so you're going to continue to pay a interest-only payment based on a simple daily interest calculation of the outstanding balance, not the commitment amount of the line, the outstanding balance.
Right.
And so as rate changes, our rate would change daily with prime rates. And so we keep it a live and active rate calculation based on current prime. Rate goes up. Let's just assume that the carrier rate is 5%. Mm-hmm. They're on the lower end of that carrier spectrum.
All right.
And rate prime gets up to 5.5, and that's your rate. Well, there's a couple questions to ask. One is the line of credit based on the use of the funds and what you structured it for, is the line of credit a better option than a policy loan?
Right.
So you have full access at any given point through a checkbook or through bank draft, ACH, or wire to be able to pay funds back and leverage funds out without having to call the advisor on a regular basis. So typically, what I find is when the rate in our line is higher than what the carrier is, it becomes the question of what is the need of the funds? How frequent are we accessing them? Does it make sense?
The convenience factor.
I don't need to keep my full cash. Yeah, absolutely, the convenience factor. And so I still have clients that when the rates were higher would pay the slightly higher rate simply because they have access to their capital. They're not having to call the advisor every time because, advisors, let's be honest. I mean,
we're busy.
If an advisor wanted to be a banker, they would have signed up to be a banker.
Right. Well, and I see one other point.
So their goal is to help the client.
And one other point, Brandon, there is what's the tax deductibility of the interest on their line of credit? If they're getting a tax deduction, they would have to factor that in too, right?
Which can play a 30 to 125 basis point spread depending on how it's viewed and what it's used for. So I mean, those spreads can vary across the board, and absolutely that arbitrage plays in all the way through.
And also, typically on most of these types of contracts, if the interest rates are coming up, the returns in the policies are higher, so there's typically still a positive arbitrage scenario going on. In other words, they're earning more, they're getting charged more, but they're also earning more. So there's still that positive arbitrage scenario in many cases.
Correct. Yeah. Very good point.
Exactly. So I see that often. Well, hey, that went fast.
I think the thing to
go ahead. I was going to say.
I was going to say very quickly. Let's just say that does happen, and a client wants to go back to a lower rate with the carrier. That's a very simple transition. It's simply just a policy loan to pay off the line of credit, the release of assignment, and they're back to the carrier.
So they can always take the lower rate, bottom line. So that's awesome. That's a good point.
Absolutely.
Stay tuned because I've got Brandon on. He's agreed to stay with us on the whole show. So we're going to go into some more stuff in the next segment. Don't miss it.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to the Your Personal Bank Show, and we've got a really exciting show today. We've been talking a lot about, well, as I said at the beginning of the show, people ask me, what is your personal bank? And from a big picture standpoint, it's a financial concept that's strategically integrating bank tools with insurance tools to maximize growth on your money with some floors, some safety, some tax benefits, and most importantly, positive arbitrage. And I've got a guest on with us today. He's been doing great with us, Brandon Miller. He's the Director of Life Equity Lending with M&M Bank. And Brandon, when I say positive arbitrage to somebody who may be not familiar with that term, what am I talking about?
Yeah, I mean, just that you have access to leverage your money. I mean, let's be clear. It's the client money, to leverage their money at a lower rate than what they're earning. So spreading that gap, borrowing at a lower cost than what they're earning within the policy, within the return itself.
Right. And in most cases, when I'm dealing with clients with this, and of course, when we recommend this combination of tools, the policy's earning more interest than what the line of credit is going to charge them. And currently, your rates are at the floor, 3.95, which we expect that to stay for, well, through 2022 at least, it sounds like, with the Fed, right?
Right.
So the opportunity is there for quite some time. I want to touch on, so I'm getting a lot of folks that obviously has expressed some interest. Brandon, if somebody was, who would be a good candidate for this type of product or this combination?
Yeah, great question. And there's some industry specific I can dive into, but I'll be honest, Ference, I would say anyone who has cash value, that if they're sitting on cash value and they have a need to borrow, this is a great tool to borrow from.
Right.
Putting aside the original design and the main design of a life insurance policy being the death benefit,
right,
the cash within, if they're needing to leverage it now, have an opportunity, have an emergency if they're paying debt, if they're wanting to make an investment, whether that's a business or personal investment. But we see this across the board. I mean, I see it for home renovations in lieu of a home equity. I see it for college, for weddings.
Right.
I see it as gifts to children who have finally grown up and can handle some cash being placed in their hand. But most important, I think we see it, or most common. Let me not say most important. Most common, we see it in the business operation or business startup, and then in the real estate investing space.
Right. That's where I see it most often. But by the way, Brandon, I've even been sharing with some of our clients, look, even if you're not taking a policy loan or you don't have a need for cash at the moment, I'm encouraging them to get the line set up anyway, because just in case they do have a need, an emergency, something comes up, well, there's no loan fees, and if they're not tapping the line, there's no interest charge, right?
Correct. Yeah. So again, that interest-only payment that we charge on a quarterly basis is only on the outstanding balance. So
right.
that non-used funds, non-leveraged funds are not costing the client anything, because we don't charge a startup fee or an annual fee,
right,
and then there's no prepayment penalty. So as monies are as cash is flowing and monies are back in the account, they can pay that line down to zero and sit on it. I've always been a believer. Yeah. Obviously, cash value is a little bit different because it's available and they can get it through the carrier.
Sure.
But emergency and opportunity never, or rarely, should I say, give us advance warning.
Right.
Emergencies come at a last moment. Opportunities come at a last moment.
Right.
And so, 16 years in the industry, I have found and often talk with clients about the reality of having it and not needing it always outweighs needing it and not having it.
Right.
And
there's no downside for setting it up, as I point out, and there's nothing but upside. And then if you do indeed need or see an opportunity for accessing the funds that makes sense, well, gosh, your money's still making a positive amount in the difference of what you're earning in the policy versus the cost of the line. So the money's still growing, in other words. in most cases. So
Absolutely.
So if somebody's interested in looking into this, what are the qualifications? What do they need?
It's a very simple underwriting, much more streamlined and less strenuous than a traditional lending product. Again, because we're cash secured by high quality, high rated carriers,
Right.
And so we have a short form application. It simply has applicant, co-applicant, those fields accordingly to how that needs to be structured. Then it has a small form financial section in it, just essentially asking high level asset, liability, income, and expense. And then there's a signature line. We go ahead and get a carrier sharing authorization form, so that way we can get anything we need from the advisor or carrier,
Right.
which we can do that once we're assigned, but on the front end to get the policy details and all. And then a copy of driver's license. The only caveat to that, because we do write these lines, or we will write these lines for trust-owned policies and business-owned policies.
Okay.
And so, of course, with both of those entities, we would need the supporting documentation, the resolutions, the trust agreements, and then
Sure.
the tax ID information to make sure that the appropriate signer is signing for the loan.
Yeah, I know your application's like 1 or 2 pages, I think. I was filling one out myself, actually, for one of my policies. So I'm in the process of doing that. So it's very simple, very easy. And how long does it take typically for an approval?
Yeah, so let's talk all the way through the process.
Sure.
From start to funding. We get your application and all the supporting docs today. I submit it to my underwriter. I typically have an approval within 1 to 2 business days. Immediately following that approval, the docs are packaged. Because some carriers still require a notary on assignment, we still FedEx docs. And so so those docs are dropped FedEx overnight. They arrive to the client. Client signs them, sends them back in the envelope provided. And then once we receive them back, we go ahead and submit the assignment to the carrier. That's where we lose control of the timeline. So when I say start to finish, 14 to 21 days, the majority of that, because the carriers will all tell us 10 to 14 days for them to perfect the assignment, although sometimes we get them same day.
That's excellent. So, and if somebody has some credit challenges or anything like that, is there, what should they be looking for there for this line?
Yeah, so good question. I'm gonna dive a little bit deeper into that because that question comes up often: is my credit pulled or how does it show? So,
right.
We do an initial credit inquiry through TransUnion. We do not report the line of credit as a debt item going forward because it's a cash secured line. So we don't want to mess up future debt to income ratios on other borrowing and things of that nature. What happens if we pull credit and credit's low? We're not so much looking for the credit score as much as we're looking at what are the factors for the low score if it is low. If debt to income is drastically out of alignment, then we're gonna obviously have some questions for the borrower. But most importantly, what we're looking for is a federal or state tax lien, because that is the only thing that supersedes our assignment on the policy and would prevent us from collecting in the event that we needed to collect and they were there in front. So that we're really looking for something that would supersede, and that being the thing that would.
Sure. So if somebody had a lien or a judgment, that's probably a no-go. But outside of that, it might work for him.
Yeah, so I think it's not necessarily a no-go as much as it will be some questions. Case in point, we had one even today, $3.2 million commitment. There was a $27,000 state tax lien. Reached out to the client. It was a recent. He was unaware of it. So what we'll do until the point that we get a letter showing that it's been satisfied or been worked out, then we'll hold $30,000 or $27,000 out of the line of credit. We'll just put a freeze on it. So when it is freed up, we can just release the freeze and the full amount is available to this client.
Excellent. Well, I'll tell you what, we've been going over a lot of great stuff today, Brandon, and we've got one more segment with him. So I'm going to really encourage you to stay tuned because what we're going to talk about next, we've been discussing how these lines of credit, these bank lines of credit against policies can create a positive arbitrage situation. But what if you have investable assets and things like that or a combination? You can handle those too also, right, Brandon?
We can.
Absolutely.
I look forward to sharing a little bit about that.
Stay tuned. We're going to talk about that next.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
All right, we're rounding third coming into home, and we have had an awesome show today. We've been talking about, positive arbitrage. In other words, combining bank financial tools with insurance industry tools where you can grow your money at a higher rate than if you access funds and you're getting charged, which creates a positive arbitrage on your money to use it for any purpose that you see fit, whether that's paying off debt, purchasing other items, investing in other assets, whatever that may be. And I've got a special guest with me today, of course, Brandon Miller. He's the Director of Life Equity Lending with M&M Bank. And again, Brandon, thanks for being with us today.
Yeah, thanks for having me.
Yeah, we've covered a lot of great stuff today, but and like I said, the key point is, again, understanding using these tools in combination. You're using tools from two different industries, and the policy, the money's in there. It's designed to grow cash. It's growing, and you want to access funds from it for whatever reason. And in most cases, the costs on most policies these days, 5%, 6%, 7% is pretty typical. Some are a little lower, but the lines of credit with M&M Bank are at like 3.95 currently. And the interest on that loan, if it's used for business purposes, could also be tax deductible. Correct, Brandon?
That's correct.
Absolutely. Now, we've really been focusing a lot on the on using policies. Whether it's we're talking whole life, IULs, universal, variable life, all of those can be used. Differing amounts are available, but you can do all of those. But Brandon has also brought my attention that not only does M&M offer lines of credit against policies, they also offer lines against combinations of assets, including investment assets. Tell us a little more about that.
Yeah, so I think you used the word earlier, Ference, synergy. You used that word several times, and I think for me it's always been how can we be a comprehensive resource for a comprehensive plan? And so most of us out there not only own whole life insurance for those that do, but you also have securities, whether qualified or non-qualified. You've got a level of securities, and so what we do is we write the life equity line of credit. We have an investment-backed line of credit for those non-qualified investment accounts, and then we have a combination line, being able to take a blend of cash value in a whole life IUL, UL, VUL policy, and then the cash of a non-qualified investment account, blend those together into one operating line of credit, and help a client leverage across the board the funds that they have for the needs that may arise.
Yeah, that's really awesome. Now, I understand there's differing levels of how much funds are available in the differing assets. Is that right?
It is, but we just take a blended amount and blend it into one line, even on the varying LTV numbers. Okay,
so obviously the highest liquidity available, in essence, would be for things like whole life contracts, like you said, up to 95% of the cash value. Index universal or universal would be more like 75% of the cash value. And then you've got what would be the rate, say, on investment assets? What percentage?
Yes, on investment assets, typically 50%. Okay. We'll look at it based on the investment class to see if we can get any higher percentage on lower risk investments. But 50% is the baseline and the norm. And so then we just take those combined numbers, blend those into one line at the various LTVs, and pull the line up to a total amount.
Got it. So in other words, if somebody had, like I said, half of their money in an investable asset and half in a whole life contract, for example, you could blend those two and give them a higher percentage on the overall amount of portfolio, right?
Correct.
Absolutely. Well, like I said, this is exciting. I've been sharing this idea for quite some time with a number of folks and sharing with our clients, and the response with our clients has been pretty much universal. A lot of excitement because, as you and I, Brandon, have spoke before, whenever you have a situation where you can increase access to funds, increase your liquidity, use for dollars, for whatever purpose, like I said, I always talk about the three big ones are paying off debt, purchasing items, or investing in other things. And like you said, what are you talked about it in the last segment or two, but what are some of the uses that you have seen? And maybe give us one or two of the more interesting ones you've seen using this, just for fun.
Yeah, I think it's across the board: debt, investment, opportunity, emergency. most often and most common is getting into the real estate space, somebody buying a investment property, a flip property, a rental property, whatever it may be, and then also the business operations. Nothing out of ordinary comes to mind or unique in the sense of what I've heard. The good news to this is a lot of times we don't hear the specific of the borrowing need because we don't have to know the specifics.
True.
One of the differentiators of a traditional loan, we're not attaching it to what the purchase is. We're attaching it to the cash value of the policy, and so it gives the borrower full flexibility to use it for what they want.
Yeah, there's really no restrictions on what they can use that money for. Correct.
Correct.
Right, and so and then also as we spoke about in a previous segment or two, that if those monies are used for a business purpose, the interest on that loan could also become a tax deduction for that business.
Correct.
So I love sharing with folks, business owners or entrepreneurs who really, look, you can grow your money on a tax deferred basis in the policy. And folks, remember the funds are staying in the policy, so they're going to grow and max earn whatever they're going to earn, whether it's a whole life, IUL, universal, whatever it is. Money's just going to grow in that contract and do its thing without any restrictions. But then you have this line of credit alongside it. The policy is the collateral for the loan, so you don't have any other issues or fees or costs or those kinds of things. And now you're using the money at a lower rate typically than what you're earning. So your cost of borrowing is less than what you're earning. Yeah, you get a positive arbitrage scenario. And again, you can potentially, with, like I said, entrepreneurs, many are growing money's tax deferred and accessing it and getting a tax deduction on the interest because it's a business purpose. I just love it.
Absolutely.
So is there anything?
The question always asked is what are you waiting for? I mean, people are sitting on their cash and
right.
And the opportunity to leverage it. So it's a great tool. I love being a part of it, working with advisors and their clients alike to be a part of that process.
And when I'm sharing this with clients and stuff, it's rare that you find, Brandon, a situation basically every party involved wins. Obviously the client, the individual, gets access to monies. Their money continues to grow even if they're using it for other purposes. There's some tax benefits involved in most cases. So that's a win for the client. The insurance company is happy because all the money's in the policy and they can use it to invest and make more and do their thing. So they're tickled. And you, the bank, you guys are happy because you're able to offer a loan and charge interest and make a profit from the interest. So you're happy, right?
Absolutely.
Yeah, so we got a win-win-win situation. I love what you said. What are you waiting on? So what I recommend you do is contact us at yourpersonalbank.com. Get some more information on this. It's a very easy loan to qualify for. Brandon shared with that earlier. If you missed some of the earlier stuff we talked about, again, go to the yourpersonalbank.com. Listen to the previously recorded show. Contact us. Get more information and look into how this can make a difference and enhance your financial future. Brandon, thank you for joining us on this show. Stay tuned every Tuesday at noon for the Your Personal Bank Show on Money Radio.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.